Hi, everyone. Welcome to this latest episode on Forecast Direct, where we have conversations with experts on matters of US and California economies. Today, we are honored to have our guest, Song Yu, with us. He is an economist with research interests in climate risk, insurance, and household finance. His work experience includes working as a former climate research economist at Freddie Mac and as a postdoctoral research fellow at University of Pennsylvania's Wharton Risk Management and Decision Process Center. His paper, co-authored with Caroline Kowski, The Role of Insurers in Driving Post-Hurricane Risk Reduction Investments, has been published at NPJ Natural Hazards. His other paper, Improving Household and Community Disaster Recovery, Evidence on the Role of Insurance, also co-authored with Caroline Kowski, received the 2025 Robert C. Witt Award from the American Risk and Insurance Association. Today, we will primarily speak with Song about his working paper titled Wildfire Insurance Availability as a Risk Signal, Evidence from Home Loan Applications. So, Song, take it away. Give us a whole overview of the paper. What was the motivation for this study? What led you to explore the topic of homeowners insurance and desirability in locations risky to wildfire?
Yeah, thank you for having me. Before we jump in, I actually wanted to say that the views I'm sharing today are my own, so they don't necessarily represent any of the organizations I work with. So, all right, with that out of the way, let's talk about the motivation of this work. So, I am personally an insurance person uh, who's interested in climate risk. So I'm naturally drawn to any of the recent dynamics in the insurance market and the economics behind it. So a couple of years back, there were already plenty of talks about insurance companies refusing to renew policies in California. And at the time, one of my co-author, Carolyn, and I were talking about this, and both of us got curious about not just the choices made by the insurance companies, but also about how their choices affect people's decisions. um, just imagine a family searching for their dream home in California, right? And maybe in the mountains surrounded by trees, flowers, birds, and they find the home they love. But when they call the insurance companies, none of them are willing to insure the home. And suddenly the dream feels quite risky, right? And I bought my home a few years ago. And I can tell you, the thought of losing the dream home you spent weeks searching for could be extremely stressful. So, and that tension between housing and research is what got our attention. And in this study, we look at California, which happens to be the center of the so-called insurance crisis because of all the devastating wildfires in recent years and the fact that insurance companies pulling back from some of the riskiest areas. So what we really wanted to know is how does that affect people's decisions about where they want to live and whether they even apply for the mortgage? And personally, I come at this as someone who is more interested in insurance markets, but I think insurance itself is an incredible, powerful signal that functions far beyond just as a tool of financial protection, right? It actually shapes housing demand and how desirable a neighborhood is. So the paper is really about connecting these two worlds, insurance and housing, and showing how one affect another.
That sounds really interesting. And the paper actually delves into a lot of different avenues, which we will discuss as we keep going. And all the results are interesting. But since this is one of the few papers that explore the comprehensive view of the highest housing demand dynamics, extending the expansive research on lender behavior against climate-related market changes, we'll focus a little bit more on that in this discussion. So focusing on the housing demand side analysis, what would you say are the primary findings, and how do these findings contribute to the related literature in the field?
Yeah, so when we look at the data on housing demand, just to know the way we capture housing demand is by looking at home loan application data in a very granular way. And I'm sure later on we'll talk more about this. But the big finding is quite striking. We find that when insurance companies pull back, people become less interested in homes in risky locations, and fewer people apply for mortgages in those risky areas. So we think it provides a quite clear evidence of how this reduced insurance option in the market is affecting housing demand through signaling this heightened fire risk at a location. Um, we also observed this change in the housing preferences quite consistently from two different groups. Uh, the first population are those existing homeowners who already own a home in risky areas, and the second population are the potential home buyers in the market. I'll get into more details on how insurance availability mean differently for these two groups later. But even though these findings might sound quite straightforward, if you look at existing literature, a lot of housing research focus on prices, right? Meaning whether home becomes more or less expensive. Uh, and if you look at insurance research often focus on how insurance companies themselves behave. So what our study really want to do is to bring these two conversations together. It shows that insurance availability itself is a signal risk that directly affects where people wants to live. I also wanted to mention that in recent years, there has been a growing body of literature that connects climate insurance and housing market. But in general, I think there are relatively more research on how climate insurance affects lenders' decision, for example, which is more directly related to a mortgage supply. But nothing has been done on the housing demand side. So I think our research fill that gap quite nicely.
No, yeah, I agree. I think there are many papers in the research in this field that actually use housing values as a proxy for demand or desirability in a location. And I also have a working paper looking at the impact of fire insurance non-renewal moratorium on the zip code level average home values of locations across different fire risk zones. And my paper also uses home values as a proxy because it's difficult to come across exact demand data. So I think it's amazing that your access and application of home loan data it's really enriching in this context, and it deepens the understanding of the demand side comprehensively and in a much more accurate way. So why don't you tell us more about the details of the geographic scope and the granularity of this data?
Yeah, so our research zooms in on California because it's really ground zero for the wildfire insurance crisis. But what makes the research really interesting is how granular the data we have. So we're not just looking at broad state level numbers. We are specifically looking at loan level mortgage application data. And on top of that loan level application, we combine it with detailed wildfire risk maps and structure level information, as well as uh, information on where insurance company has put back. So this means we actually have a quite detailed record of who these people are, where they live currently, where they look into buy next, like what are the characteristics of all these homes, and how risky at the location of these homes. And with this data, we then can see at the individual level how people respond when insurance becomes difficult to get. So it's kind of like watching the market breathe. So you can basically see the demand contract in a very specific high risk location rather than assuming it is the risk is the same in the same zip code, for example. So the story here is not just about California as a whole, uh, but about very real shifts happening location by location and neighborhood by neighborhood. On the insurance side, this high granularity is also very important because uh, insurance company actually use both community level and property level information to make underwriting decisions. Just to give you more details, while working on this paper, we actually reviewed the rate filing from the top 10 insurance providers in California. And we looked for specific language on how they make decision on whether to renew policy and whether to write a new policy, whether to write a new policy. Um, from what we reviewed, many of them actually indicated they would first identify zip codes where the high risk policy were concentrated. And then within the high risk zip code, they then select the highest risk to non-renew. And similarly, when it comes to write new policies, their general underwriting standards are much more stringent in high risk zip codes. In this way, so our this location level, contract level data would allow us to capture this kind of insurance company's decision more accurately.
That sounds really interesting. I think the granular data at the property level is going to help a lot in understanding the exact demand dynamics. So, just a quick sub question to the original question. So, for people
Yeah.
looking to relocate into risky locations, does your data also include people trying to move into risky California locations from outside California, or does it only include people within California?
Yeah, that's a great question because people often assume we're only tracking people living in California.
Mhm.
But the answer is yes. Our data does also capture people trying to buy in risky California locations from outside of the state. And that's actually quite important for the way we study this, because in our setting, it doesn't really matter whether you live in California your whole life or whether you're moving from places like Boston or Denver, right? What really matters is whether you can get insurance for the home you want to buy. And if coverage is harder to find, or that's really the major barrier we're looking at here, no matter where you're coming from.
That makes sense. Okay. So now moving a little bit further into the results, there are some very interesting results on both existing homeowners and potential homeowners. So first focusing on existing homeowners deciding to move out of a location based on wildfire events and moratorium. What are the primary mechanisms that you think drive this decision making by existing homeowners? And in simple terms, can you also give us a magnitude of the impact that you find?
Yeah. Let's first talk about the people who already own homes in wildfire prone areas. Um, if you think about it, for them, the challenges they're facing actually come from several dimensions all at once. Uh, so first, they face this obvious risk of their homes being burned or damaged by wildfire, right? But on top of that, their insurance policies are also more likely not to be renewed. And even they do get stay covered, they may also face higher insurance premiums. And any one of these factors could potentially affect whether they want to stay put, move, or whether they want where they want to move next, right? So to really isolate this effect of insurance non-renewals from all these different wildfire related pressures, we used what's so-called a natural experiment in California. Um, and this is just to give you a little more policy background. Usually after a major fire, the state of California puts in place a 1 year moratorium. What the moratorium does is to prevent insurance companies from dropping existing policies. But once that protection period ends, which is a year, households again become exposed to insurance non-renewals. So this policy actually creates a quite nice before and after window for us to look at, where we can see how households respond differently to the insurance options. And what we find is also quite telling. We find that households facing a high likelihood of insurance non-renewal start shifting their housing preferences once the moratorium ends. What becomes different is they become less likely to search for homes in risky areas or in places surrounded by heavy vegetation. And if you look at the magnitude, the size of the effect is also quite large. Those most likely to lose insurance actually cut their interest in buying high-risk homes by almost half once the protection is removed. And remember, when insurance companies don't renew policy, they usually have to tell you why. For example, they'll send you a letter saying, we're not renewing policy because the wildfire risk at your home's location is too high. Right? So that kind of disclosure itself is kind of riskinal. It tells people something about the danger of the location, and we see this kind of evidence that this risk information actually influenced their future choices. So the takeaway here for existing homeowners who already own a home in a risky area is insurance is not just a financial product, it's actually also a channel of information. So when insurance company refuse to renew a policy, that sends a very clear signal that affects how people think about risk and where they want to live.
That's really interesting about the people who are choosing to move from while they had started off in an existing risky location. But I also saw that the paper explores a more nuanced and a novel analysis of the intent of new or potential homeowners searching for homes to move into these risky
Mhm.
locations. And I've found that even more interesting because these are not people who have experienced anything yet, but they are looking to move into risky locations. So, what are the primary mechanisms by which these potential homeowners interact with the wildfire risk? And what is the magnitude of the impact here as well?
Yeah. Now let's turn to people who are looking to buy a home in California.
Mhm.
Just imagine you just got your loan pre-approved and you're checking out different homes. You finally fell in love with a house and get a house under contract after going through a bidding war. But then the lender says you need insurance before you can close the loan, which is usually the case, right?
Mhm.
Then you start calling around and realize it's really difficult to find insurance. And so for many home buyers, that could be the end of the road. So I think that's where insurance acts like a gatekeeper here. It basically decides who can get to compete for a home in a risky area. And if the door is locked, home buyers simply can't enter the market, right? And in the data, we do see this part play out nicely in risky communities. The applications for high-risk homes actually fell sharply by about 10 to 40%. As insurance becomes less and less available, the volume of applications for high-risk homes fell even more. But at the same time, if you look at applications for low-risk homes in these very same relatively risky communities, the numbers actually went up by about 5 to 12%. So what we're saying here is not just an lowered overall demand, but the reshuffling of the demand away from the risky spots and towards safer ones but nearby. So if you think about it, it's kind of like buyers are really making a compromise here. They're choosing homes are less exposed to wildfire risk, but still in the same neighborhood that would allow them to still enjoy the natural amenities of the community. Um, Now, the one big question here, why this is happening, right? So we got this idea of looking at who are these home buyers remaining interested in homes in risky locations that the insurance company are not willing to cover. Uh, Interestingly, what they find here is that these home buyers who remain interested in risky locations tend to come from areas that show lower concerns about climate risk. So I think that's also quite consistent evidence showing that insurance availability itself is sending a signal, shaping the perception of the risk for people in the housing market, and that's what's driving people's choices.
I see. I think that's really interesting, the whole reshuffling. And you would imagine, I had imagined when I started reading the paper that it would be lower everywhere else, like everywhere in the whole surroundings, as well as the places affected by the wildfires. But the reshuffling was a novel finding, and I think that was really interesting. So to wrap it all up, how would you summarize the major conclusions from this paper?
Yeah, that's a very great question. I think there are two main takeaways from our research when it comes to policy. The first is that if we want resilient communities, we will have to build resilient insurance markets as well. But as you know, the climate risk is increasing, right? As climate risk continue to increase, it's just inevitable that insurance will get harder to get and will become more expensive. It's just the nature of the insurance, which is to cover the losses in the future, right? But that doesn't mean we need to give up on it. I think it means that we will need policies and markets that can adapt to this new reality. So in the short term, I think they could mean things like state level backstops, reinsurance programs, or better ways of spreading catastrophic risk. And I think there are already many public programs in place in the United States. And the way it's functioning is to make sure that insurance markets don't collapse after a major disasters like a wildfire or hurricane. But in the long run, I think the long-term solution has to be related to risk reduction itself. So for things like hardening homes, creating defensible space, and just trying to make communities safer to live in. And I think there is a real opportunity here for the insurance markets to be part of the solution. And that leads to the second takeaway of our research, which is I think insurance markets could play a powerful role here in encouraging risk mitigation by sending clear and powerful signals. So this could include start offering coverage in risky areas when homeowners take steps to reduce their risk, right? Or this could also include provide premium discounts when homeowners implement mitigation strategies. So the policy implication here is really twofold. Stabilize insurance markets so they can keep functioning and at the same time try to harness their ability to encourage this kind of investments that will make communities more resilient.
That makes a lot of sense. I think, given the fact that there has been unfortunately, a lot of wildfire events lately, I think this research is extremely topical, and your implications for the insurance market are also helpful in informing the policymakers what can be done about this. So, thank you so much, Song, for joining us. Thank you to the audience for tuning in. We're looking forward to the next episode on Forecast Direct.
Thank you for having me.